Good afternoon, ladies and gentlemen. Thank you all for attending our third quarterly update for the year here. Just a few brief housekeeping rules before we dive into the agenda here. We've got quite the packed itinerary here to go through. This meeting is being recorded and a recording will be made available afterwards for you to review in your own time. Just a few housekeeping rules and disclaimers here before we get started. So this information is being presented for educational purposes only, and nothing included here should be taken as any advice, nor any strategy discussed herein. With that said, please do ensure that you consult with a qualified financial advisor and/or tax professional. With that out of the way, we'll jump right into the agenda here. Oh, one thing I did forget to mention, there will be a dedicated Q&A section as well towards the end, so please do feel free to put your questions in the chat and we'll do our best to answer them towards the end, or alternatively, we'll pick through them as and when they come up if they're relevant to the topic at hand here. So we've got a number of things going on here in the last couple of weeks and last couple of months, really, to unpack, ranging from the central banks, currencies, and also going forward what everything here actually entails. But before we do that, markets are actually at all-time highs here. What's actually led this rally in the markets in the last few weeks and months here, Brian? And why don't we just sort of unpack the chart that we're looking at here for our audience?
Well, we are at all-time highs, which is forever a blessing, and yet it is so typical when we look at those long-time charts. It's the majority of the time, and we're getting this on strong earnings and on some stability for once. While it feels like the whole world is erupting between the 70 elections or so we had this year, Josh, was that? I think it's 72 if I remember
That's
correctly.
about right. Yep.
Yeah, and
Studied.
and we have 14 days left until.
Oh, yeah, there's another one that people might have heard of. Yes, it's kind of been kind of leading up to that crescendo, isn't it?
So all of a sudden we have all that instability of these elections, but now as we get closer to the election, it feels like we get a lot of potential tax cuts and a lot of economic remedies that might be helpful. But at the end of the day, what's really coming down is we're getting good fruitful earnings, all the way down to the banks. And it's been a good long while that we've seen stability and good earnings from the banks. So we're really happy to see that, and I think even more fun if Cam, can you help me devour this second chart in there? Because that asks that age-old question, should I go ahead and invest when the markets are all-time highs?
Absolutely, and this is a great research piece here by the JP Morgan Asset Management team. And essentially what we're looking at here, on the left-hand side, you've got the S&P 500 index there, going all the way back to 1950. And the research that the JP Morgan team has done essentially answers that age-old question of, what are your longer-term returns for investing on any given day versus investing at all-time highs? And as we can see here, despite the fact that the short term, there is some discrepancies there, but over any period longer than 1 year, investing at all-time highs actually, from a cumulative return perspective, ends up coming slightly further ahead than investing on any other day. Now, there are certain nuances as to why that is. It could be, for example, new companies being added to the index that are having a larger and larger sway, or just purely from a technical perspective, when an all-time high is broken, then you typically tend to have that momentum carry forward. But again, it is an interesting insight into the psychology of markets and why if you've got a longer term view, investing in at all-time highs or any other day shouldn't really impact your longer term decision making.
So we're going after the momentum play.
We are indeed not going after the momentum play there. But I think before we get ourselves a little carried away and in trouble there, I want to move on to a couple of planning items here that we've got on the docket, namely particularly for our US
planning. It's more just good news.
We're going to carry on with the gravy train here and continue with the good news. But I think there's been some adjustments to Social Security. So if we get my colleague Isa here to jump onto the webcast, and why don't we break down what's actually gone on here and how it actually impacts all those millions of Americans?
Yeah, sure. So the Social Security Administration in the US has announced that they will increase the benefits as of next year, so starting in January, by 2.5%. So that's a quite nice increase, and it's an adjustment to the increase that we've seen due to inflation in expenses. On this chart, you can see the cost of living adjustments over the last about 40 years. So you can see there's always been some kind of adjustment, sometimes more, sometimes less. On average, we've seen it about being about 2.6%. So 2.5% is right in line with that. And yeah, this is actually a very nice thing to know that you have these adjustments there, because that naturally means that the retirement that you will receive will continuously increase, and therefore in your plan will make sure that you will be able to cover kind of the adjustment in your expenses better.
So, Isa, quick question. As most of our clients are American expats that live abroad, will they be able to take part in this?
Generally, yes. So naturally, as an American living abroad, you may have worked a little bit in the US, have some credits there, but not enough to actually qualify for benefits. That is no problem if you live in a country that has a totalization agreement with the US, because then you can kind of between the two countries where you work now. So let's take Belgium as an example. Belgium and the US have a totalization agreement. So if you've worked for many years in Belgium, a couple of years in the US, the years that you've worked abroad will qualify as well and give you the benefit there. It's going to be a reduced benefit, but you still will receive that 2.5% adjustment.
Perfect. So it's not like the UK, where if you move abroad, you no longer get any inflation increases. So in other words, our retirees shouldn't be worrying about inflation increases because they're getting an increase in their payment. What about all of us that aren't yet retired? Are our future Social Securities going to be increased by this?
Yes, so the Social Security benefits that you're expecting to receive later on will also be increased by this. So if you're currently working in the US, that will also mean that the threshold of the income that is subject to Social Security is also going to increase a little bit. So yeah, it is going to affect you as well if you're not retired yet.
Wonderful. Any top tips on how to figure out when you should start taking your Social Security, Isa?
So generally, it's a very naturally very subjective and personal decision when to take your Social Security income. So it depends on various factors such as how much do you have in savings, or first of all, when do you plan to retire? If you're planning to work until you're 70, well, then you don't need most likely a retirement benefit at age 67 or earlier. And as you take the Social Security benefits later, they will also increase. So every year that you delay taking the benefits, you will be able to get a larger benefit proportionally. So there's a certain calculation to that. So in other words, if you delay until 70, the 2.5% increase is going to be higher than when you take it at 62. Now, whether or not to take it at 62 or 70 or 67 or any age in between depends on the amounts of savings that you have to make up for income that you don't have after retiring. If you retire, let's say at 60, you want to make sure you have enough money to cover that period until you start the benefits. Or as said, if you're working longer, then you can easily extend the period until you start the benefits.
So long story short, everybody's going to be a little bit different, and they should be contacting you, Josh, and to make sure that they develop a good financial plan that incorporates that Social Security. Because even though we love to fearmonger about it being gone years from now, they're still going to be paying out. And therefore, it's still an important part of your financial plan. Thank you.
Exactly.
That's great news. We'll check in next year for some more great news.
Indeed.
Hopefully we'll keep the good news rolling there, but time will tell. Excellent. Thank you very much for that insight there, Isa, for Social Security for our clients. Moving on to the next topic at hand here that we have, which is what's actually going on here. So there's been a lot of headlines in the news and the papers, depending on which you've been following. But what we're really here to do is dissect the noise, from what's actually important. So figure out where the forest is from the trees. And the next chart here that we're looking at is pretty interesting, because I think one of the headlines that have dominated the news cycle in the last couple of months and weeks, Brian, has really been what the central banks have done. Particularly the developed markets. So why don't we sort of unpack what the different central banks have done, how has that impacted, their domestic currencies, and potentially what we can expect to see going forward?
Well, it's been an interesting couple of years. We'll recap the last couple of decades and then get to the last couple of years, and then hopefully people will forget about us making predictions about going forwards, and then we can't get it too wrong. But we had 4 decades where interest rates were pretty much universally going down across the world, mostly because they spiked up so high there in the beginning of the 80s. But essentially 4 decades of interest rates going down. That really helped drive a lot of asset classes up, including real estate. But it didn't hurt the stock market in any way, shape, or form. And therefore, we've had a pretty good run of things. Now, as you'll remember, a couple years ago, inflation spiked quite high, probably the result of how everybody dealt with the COVID crisis, and supply chains from the COVID crisis, etc. So our central banks hiked up interest rates to try to reduce that inflation. Last year's numbers, sorry, Isa, to burst your bubble, but not as they were much better than this year's numbers, but it's because the inflation numbers were a lot higher. So security went up a lot more last year. Now it's starting to come down in line with inflation. And that's to where we've started to get a pullback universally amongst the 3 big central banks, i.e. Europe, Bank of England here in the UK, and the Federal Reserve in the United States, of trying to temper and bring down interest rates. Now, the question is, how fast and how far will they go? I think universally, amongst all the big banks, they go on a 3-year factor. So we're probably looking at 2026, and we're probably looking at, amongst the different analysts, about 5 to 7 rate cuts. Would you say that's about right? Cam, the fact checker?
That's exactly spot on, Brian.
So when we're thinking about that, it becomes the question of how fast is this going to happen, and will they all happen? And that becomes one important thing, but as long-term investors, it means we just need to be in the right asset classes, and then we don't have to get every part of that right. But as you can see from the top 3 lines, the Bank of England has the highest interest rates, then essentially the Federal Reserve, the second highest, and Europe's quite a bit lower. Now, what does that really mean? It means that we expect the euro to be a little cheaper as a currency, just because of all the movement of those assets. So the higher interest rates will drive a little bit higher currency. And that's why the pound has had a little bit of strength, a little bit of wobbling around on big news, which will include Rachel Reeves' budget that will be coming up on the 30th. You can ask Josh all your questions on that later on if you do have any, but we'll just be speculating on it. So I'm just teasing on poor Josh. So now that becomes the more important factor, is how these interest rates will impact the currency markets, which could drive further returns, right? So essentially, that's why we're so concentrated on central banks and what their activities could be. And right now, with our inflation numbers on the US side, and then followed up by great numbers when it came to new unemployment claims, that gave the Fed the ability to potentially stay higher for longer. So they don't meet until November 6th, but the minute they meet, everybody's speculating about what they're going to talk about on the next meeting. And now we're waiting for that November 6th time period, but we might not necessarily need that rate cut because the economy is quite strong on the US front of things from the vantage point of inflation and unemployment. Whereas here in the UK and Europe, there's not that same stability, so we might see more rate cuts faster over here. And if we see more rate cuts faster in Europe and the UK, we could see a much weaker much weaker pound and euro if that comes about. The pound interest rates are much higher, so they have to go further down to weaken it, i.e. they'd have to get beneath that line, whereas the euro is already there. So that's where this becomes such an important viewpoint. If the opposite were to happen and the dollar were to go down, that'd be very accretive to the stock market. But if essentially we get strength in the dollar, that's going to continue to give us strength in our fixed income positions, which are mostly dollar denominated, because a strong dollar would then translate to stronger returns in our currencies that we're living in. Mm-hmm. So that's why this really breaks down exactly what our playbook has to adjust for in the next couple of years.
Excellent point there. And I think one of the points that you really mentioned there, Brian, is, there are a couple of things that drive currencies, but really the three key factors are interest rate differentials. So, what's the difference between interest rates in one jurisdiction versus the other? But the thing that most people tend to overlook, and what you really touched upon there, was the growth rates, right, of a particular country. And I think for a very long time, growth has languished quite significantly, both here in the UK and Europe to even a greater extent. So would you say it's a bit of a fine balancing act, right? Where, for example, the Bank of England and the ECB may have to cut rates faster and more aggressively than the Federal Reserve to, bolster their growth rates. But would you say that potentially better growth prospects here in the UK and Europe could potentially balance out some of that currency weakness?
Well, the currency weakness should drive growth. So one in turn should turn into the other. And therefore, if you weaken your currency to drive some of that growth, that can actually hopefully come about fixing some of the problem. But it also helps with the deficit, which is what Rachel Reeves is going to have to really concentrate on here in the UK. How do we go ahead and repay this large deficit that we've stacked up from COVID when we have a weakening economy? So each of them are going to play in turn. But at the end of the day, we've got three central banks that are dealing with three totally separate economies at this point in time. And the US is looking strong, so it's gonna continue to be the weighting inside of our portfolio until we have reason to shift that.
I know. Excellent point. I'm going to skip a couple of slides here just for the sake of time. And if we move on to our next cycle there, which, we've touched upon the cycle of, a stronger dollar going forward, Brian, but we're almost at what, 16, 17 years of that stronger dollar. What could potentially dislodge that to where, we actually enter into a period where we do get a weaker dollar going forward? I know, for example, maybe this is for the latter part in the political side where, Donald Trump, for example, has advocated that he clearly wants a weaker dollar, despite all his policies being otherwise. What, in your viewpoint, could drive sustained weakness in the US dollar and therefore, provide a bit of a ballast to the international currency bucket and particularly emerging markets as well?
Well, I think you have to just reach into your British quotes and just say, events, my boy, events. Every single big movement of a strong dollar to a weak dollar has come about from a large event. So when we think of Richard Nixon getting rid of the gold standard, that was a huge event, an unprecedented event, but triggered one big event. The Plaza Accords, Reagan basically calling in the first G5 summit and asking all the other nations to go ahead and quit buying dollars. That is a huge event. I don't think it's one of those things that we can foresee, but Donald Trump could cause some sort of event like that, a destabilizing event for the US dollar. A weakened dollar makes the economy look that much stronger. It's not really the case, but essentially a weakened currency can make it very easy to get the people to say they see growth inside of things. Let's just look at the UK. Over 10 years, we've gone from 2 to 1, and we got very close to 1 to 1 to the US dollar this last year. So a 50% drop in the currency, and yet people are still focused on the economy, not the currency. So it's a great way to bring about some sort of growth, and that's kept the real estate market strong here. So I would say it would have to be some sort of destabilizing event like that would actually tear up the current convention that is giving the US its large growth. We have to remember the growth in the US is really driven by the fact that in 1999, it became the tech center of the world, and it's only grown there since. So if that starts to spread out globally, that could bring about weakness in the dollar. If other factors started to move in there, that could be the sense, but it's going to be some sort of large event. And therefore, we could and we should stay in the dollar until we have reason to move elsewhere. The other factor that can be the case is essentially that everybody diversifies because the dollar's been the one trade for a long time. You're going to bring it up later, might as well bring it up now. The US stock market is expensive.
It is
Other
indeed.
stock markets are cheap. So if you like a good deal, you can go out and you can buy some emerging markets. You're going to go through some volatility, but you're going to buy it for a much cheaper price than you are the US markets. Same thing for the UK markets, the European markets and such. Now, as we get more stability, we've got to remember a big driver for the dollar is also a flight to safety. And in the last decade, we've had a lot of flights to safety between COVID, the financial crisis, the other financial crisis. So essentially, with those flights to safety, it starts to seep back out into the other economies over the course of time, and a little bit of stability could give us that. That might not come from Donald Trump, the stability, but that's where those two factors can come about. And both of them, one of them would be very fast, one of them would be slow over the course of time with stability. And that's where I think we can be patient with the dollar.
Mm-hmm. And I know we've touched upon valuations, and this particular slide here that we're looking at just gives us the forward price to earnings ratio for the S&P 500 going back till 1994. And for some of our regular audience here, you've probably gotten almost bored of this chart because we reference it, several times in our past webcasts as well. But I think the reason why it's very important here, maybe I could get your thoughts as well, Brian, is essentially whenever valuations start to get a little bit stretched, you start to have a lot of people come out and say things are looking expensive, therefore we have to have a pullback. So two questions here. One of them is why can sort of valuations continue to stay at higher levels and not necessarily have a pullback by the equities themselves going low? And the second question is this higher valuation that we're seeing, particularly in the US markets compared to some of the others, how much of that is because the US as a whole is very, very expensive, and how much of that is actually because the Magnificent Seven or Magnificent Six or whatever new acronym it is that the headlines have coined are really skewing some of the numbers there?
Well, it's not just that they're skewing the numbers.
They are the numbers.
Exactly. If we're looking at 1994, the components of the S&P 500 were really driven by GE, Citigroup, these bellwethers that are good blue chips. I think Cam's Googling it right now to get the exact names that are on there. But essentially, they were not companies that were demanding PE ratios that were 80 or 100, or unprofitable companies until they were long time on the overall stock market. Whereas now, when you look at a company like NVIDIA, its profit potential is exponential compared to a conglomerate like General Electric was back in the 90s. So there should be a higher ratio when it comes to PE. And that's why I think it's so important that this actually shows the Shiller PE, which is looking at a 25-year moving average of those factors and also inflation adjusting it. But that just means that the value of this chart will take quite a while to actually demonstrate true value. The markets are going to be more expensive because we have more future-driven companies that are the biggest components of the S&P 500. That's just a fact. If we wanted to just buy only true value, we would end up owning a lot of good companies, but not all the great companies. The question is, how do we balance it out in our portfolio? When does the S&P 500 not become the most valuable index anymore because it's too topside weighted by those Magnificent Seven? When do those 7 stocks not drive the markets because they don't have the ability to grow? And that's the unanswered question. We don't want to sit there and speculate too much about it. We want to try to make sure that we're prepared for it and that we diversify our ways around it. There can be ways of buying more small caps and potentially using the Russell 2000 instead of the S&P 500. There can be equal weighting opportunities inside of the S&P 500. But I tend to believe that it's finding complementary pieces instead of trying to pick the top and the bottom for each of and every one of those stocks. They're all great companies that have massive potential of increasing their earnings, but they're not interested in doing it today or tomorrow. When we think about how much Facebook spent on building the metaverse, well, I guess they're Meta now. So Meta trying to actually live up to their name. All of these companies have much more potential for earnings. So I'm not as fearful as that. I'm fearful of what happens if the government tears their opportunity away by essentially splitting them all up. And that's not fear that we're going to lose value in those companies. It's that the leaders are going to be distracted for a long period of time.
I think that's a really relevant point that you brought up, which is, exemplified in this chart as well, which is, unlike the early 2000s, which is what everybody seems to compare, today to, is that a lot of these companies, like you mentioned, NVIDIA and Microsoft and Apple, they're profitable today. If we look at their balance sheets and look at their revenue growth, these are companies that are bringing in the money or bringing in the dollar, so to speak, today. So, you're really buying part of it on today's valuation and today's earnings. But, as you mentioned there, Brian, some of the future earnings growth, especially if some of these narratives actually play out, like AI and such, with, a lot of the productivity gains that are being touted, but again, have yet to materialize. If that does actually play out, then, as you mentioned, the revenue potential is there for them to do, again, revenue only, to sort of 6 or 7x their revenues as they did last year as well. But I think that's what everybody's sort of hyper fixated on, which is that concentration in the upper echelon of the S&P 500.
There's still lots of opportunities of companies beyond just the Magnificent Seven that have performed just as well. We have cybersecurity and grid inside of our portfolios, and both of them have performed right in line with the Magnificent Seven without having to own the Magnificent Seven. And that's what we're going to continue to look for. Now, Google might try to devour a few more of the players inside of the cybersecurity fund. And, same thing with NVIDIA inside of the grid fund. But it's the opportunity to diversify ourselves, as that's the #1 rule in investing. Keeping diversified will minimize certain risks over the long haul.
Absolutely. So I guess the takeaway there is to look for that exposure where you can get it, but at reasonable valuations. And again, the key there is diversify, diversify, diversify.
You sound like Peter Lynch when you say that.
Maybe I've been listening to one too many of his past podcasts. Perfect. Just going to do a quick time check here. I think we're getting to the halfway mark, which actually leads us on quite nicely to our next topic, which, unless you've been living under a rock, it's been absolutely impossible to get away from, which is the US elections. So Josh, if we could get you up here on the webcast, and why don't you just sort of give us a state of the union of how the elections are playing, and then maybe we can get a bit of a conversation started of how the two parties actually impact the markets going forward, if at all.
Absolutely. So thank you, Cam, and hello, everybody. Well, we've had an interesting year because this is actually the year with quite a few elections. Actually, I fact checked us both, Brian. It's a 73 actually on the year.
That's
for the number of
close. That was
I know,
one off.
yeah,
One off.
yeah. Not quite close enough. Well, what's one election between friends anyway? Right off the bat, if you came here wondering who's going to win the election, you'll leave sorely disappointed. I don't know. It's still a crystal ball question, and if you're even vaguely following the news, you'll probably know that it's essentially a coin flip at this point in time, and we can get into a whole argument about what the polls say. The point is, what's maybe more relevant for our discussion here today is not necessarily who wins the election, but how the government looks in terms of how it's divided or not from a perspective of the markets, and how to take things forward from there. So this first slide we think is particularly interesting. Now, just to kind of cut to the chase there, we've got two scenarios where the president is Democrat, another scenario where there's Republican, and how things work in terms of whether or not Congress belongs wholly to one party or the other, or neither. Now, on the one hand, you'll probably notice that the Republicans tend to outperform the Democrats in this respect as far as being the one in charge. That's maybe likely not too surprising if they tend to favor tax cuts on businesses, but I would welcome other interpretations of that as well. But what I'd really like to get to is, well, the divided governments, they tend to lead to better outcomes, interestingly, when it's a Democratic president. Now, I would say that doesn't actually mean to imply that Democrats themselves necessarily better for the market. That's one of those things you can probably endlessly debate about. Is it that because they're in charge, or they're just presiding over periods when the market has done better? But it's nevertheless an interesting statistical piece there. Maybe a quick pop quiz. Does anybody know the best year the S&P's had over about the last 100 years? Anybody? Any takers? Shot out of a cannon?
That's a good question. I don't know. Any other guesses from our panelists, or maybe from the audience?
So
I
know you're pressed for time, so I don't want to spend a whole lot of time on it, but 1954. Anybody know who was president in 1954?
I think our next slide answers that question, but any
personal
takers from the
favorite of
audience?
mine, Dwight David Eisenhower, who was a Republican. So it's just to say, it's not necessarily us saying we would prefer one candidate or the other win from a market perspective, just to add a bit of context to how these things tend to work. In other words, if we do get a divided government, it's not the end of the world from a market perspective, perhaps quite the contrary. But why don't we kind of pick apart this? Because I guess this does lead to the next portion of this, in terms of, if we're working on a basis of not being sure who's going to win, does that mean that we need to start worrying about what we're doing with our money? Is this a good time to stay in the market or be out of it? And I guess we're kind of already answering that from a quick eyeball test here. But Cam, should I be pulling my money out of the market?
That's an excellent question, and I think maybe our next slide has the answers there, which is, well, I mean, it's not surprising, but I think sometimes the politics will have you think otherwise. So why don't you unpack what's going on here for us, Josh?
Well, essentially, it's just that old mantra about staying in the market. I mean, basically, you can see how, again, it's part of that old argument of, is it because of one party or the other, or just where the economy is? But, well, the idea is, if we're looking to invest, we're looking to invest for the long term, because if we just keep in the market, even regardless of who wins, and we're guided by our overall financial goals and principles rather than trying to be reactive about things that we can't control beforehand, then we just see much better outcomes in that. Well, I think the numbers basically speak for themselves in terms of the compound growth over that period of time, instead of just focusing on one party or the other. I don't know if you had any other thoughts on that, Brian or Cam.
I think it was Jamie Dimon said the other day, it doesn't matter who our president is, they can't even mess up our economy.
Yeah, it's that old metaphor, like if a smaller economy, I'm just going to pick on, I don't know, maybe we'll pick on Croatia. Sorry, Croatia. If it's more like a jet ski because of its size, I guess the U.S. is more like a tanker. It takes a lot longer to change the direction, etc. Suppose that's what you're getting at.
Absolutely.
All respect to Croatia. Apologies.
I guess my question to you, Josh, was going to be, clearly from this chart that we can see for the longer term, staying invested in the market is the better outcome than trying to, pick the highs and lows of which administration is going to actually, as we can see from this chart, doesn't really have much of an impact. But what about shorter to medium term when it comes to certain sectors and certain industries? Does that have a slightly different outcome?
Yeah, this is something that we also delved a bit into in our last quarterly update, wasn't it? So if it's something that you guys out there would find interesting to look at, definitely look at the breakdown there. This one's a little different because I guess a lot of this could be argued in terms of the timing of both presidencies, but I think what really jumps out is, I guess seems to be a huge difference in the cumulative total return on bonds in particular. I've noticed that's a pretty big difference between when Trump was in office and when Biden was in office. Does that suggest anything to do with the presidents, though, or does it more to do with the state of the economy at the time? I think that's highly debatable.
I think the most ironic part is that real estate did worse under Trump than Biden.
Well, here's your other fun trivia for the day, actually. Despite Donald Trump not being an advocate of green energy, wind related and wind power related companies as a whole did much better under Trump's presidency, and vice versa. Coal actually had one of the best sort of performing periods under the Biden administration. Now, as Josh said, how much of that is due to the current macroeconomic environments and how much of that is, the actual presidential candidate's policies, that can be debated ad infinitum. But I think that the takeaway there is, despite each party favoring one or the other type of policies, I think longer term, it's really about the fundamentals instead of
Absolutely
what particular administration is leaning towards. Sorry, I cut you off there, Brian. It seemed like you had a thought to add.
No, that was spot on. I do remember in the Trump presidency that even though he was pro coal, 50% of the coal production in the United States disappeared during his presidency. So sometimes we have to watch what happens instead of what he says. Which gets me to one big question. Josh, is he going to get rid of citizens-based taxation in the United States?
Indeed, I think that's one of the many different pieces that is getting thrown around this election cycle. I think there's a lot of noise out there. So he has made mention of that, and so his opponent Kamala Harris has not, at this point in time, made the same pledge. Whether or not this is something that's followed through is another particular thing, but it's one of the many things we've heard in this election cycle that he's toyed with the idea that that might be something that they'll be looking into, abolishing that kind of a taxation.
It'd be interesting because even the bills that we have seen out there wouldn't change much for the average American abroad. It would only it could only potentially eliminate those college students or accidental Americans that have never been in the American system.
Right.
Which essentially means that the majority of us that have investments should probably still have them in the US. So it doesn't change much at the end of the day. We have old 401ks, old social securities, anything else, we'd still be structured in that old system of not being able to own PFICs, etc. So it's also coordinating and listening to what bills would be actually rumbling around Congress instead of just what the president says, because I can't be an executive order from that vantage point that usurps 6 or 8 years worth of great work from some of these associations that have been lobbying Congress for that change.
Yeah, potentially another thing there is to look at the other the wider government as a whole. Currently, it seems like the Republicans are likely to win the Senate. The House is a toss-up. So it's not just about who's going to win the presidency, but, well, how easy it would be for them to implement that kind of legislation. So lots of moving parts there. One last thing, if you didn't know already, just because you live outside the states doesn't mean that you can't vote. So if you haven't yet, then definitely go online and look up if you're registered to vote or not. Depending on the state, the rules are all a bit different, but if you need any help with that, we had a good webinar on this a couple of weeks back, or you can just drop me an email. I'm happy to send you the information you'll need to find your way to whichever state you need to register in.
I'd insert one last thing right now, because this is the number one question that I'm asked. What do the markets like for the election? And I would say, anytime Kamala is up in the polls, the market likes it because it brings stability. Anytime Trump's up in the polls, the market likes it because they like tax cuts. And that was one of 2 things that he delivered in his presidential term. So right now, the market's kind of indifferent about this election in an odd way, because it's well supported, and both of the presidential candidates are bringing something that the market could get out of it. So I don't think we have to fear this election in any way, shape, or form, or any election, as Josh quite nicely demonstrated.
That's an interesting point there. I'm going to hold you to that one, Brian. So the equity markets I can understand from both sides, but what about the bond market? Because if we look at some of the policies, maybe Josh can chime here as well. I think everybody agrees that regardless of which candidate you look at, both of them are likely to be deficit presidents, right? Trump more so than Kamala Harris. But what does that mean for the bond market going forward?
Well, it's a really interesting question, because what's that that famous quote? If I were going to come back as anything, I'd come back as the bond market, because I'd petrify everyone.
You can intimidate anyone. Yes,
intimidate anyone. I'm sorry. That's exactly what it is. Naturally, when you look at the different 2 sets of policies, all of the economic reviews of Trump policies are that, as you said, it would increase the deficit much further than the Kamala Harris's plan. Now, the true question is, which one would bring about, or would one of them bring about any growth, and are they really going to sit by those budgets? We have to see those 2. I'd put a third one into effect. If there's constant demand for the Treasury market and interest rates can go down enough, the deficit is not as important as people are making it out to be when short-term interest rates are at 5%. Liz Truss here in the UK learned that the hard way, that people can turn on the government very, very quickly and intimidate the entire market. So it's not the size of the deficit, it's the instability that scares me. So that's to where I'm not stuck on the fact that Trump would bring about all that deficit spending. I'm scared that he would petrify the markets on a regular basis for instability reasons, which could bring about a Liz Truss type of event.
Right. So
actually, Kim, do you want to actually explain what the Liz Truss event was? Because
that's an excellent question.
They might not.
Indeed. So if nobody knows about it, I wouldn't blame you. It was all of what, 30 days, less than 30 days?
Not even 30 days.
Not even 30 days. So Liz Truss was one of our most short-lived prime ministers. And essentially, the Liz Truss debacle that happened was her particular government tried to pass through a number of unfunded tax cuts and spending. So essentially what that meant was ballooning the UK's deficit, borrowing a lot from the market, so the bond market, and then hope to spur on growth. And that growth, their thinking, at least at the time, would help pay off some of that elevated debt level. So the complete opposite of what we had in 2010, when austerity was all the rage. Very quickly, what they learned was that the bond markets don't really like a lot of irresponsible spending, and for that they were punished very, very heavily. I.e., what happened was the cost for the UK government to borrow on the public markets, I think, shot up something like a whole percentage point, or close to a percentage point. I may be incorrect there. It's probably close to 0.75 percentage points. But the TLDR, or the takeaway there, is that the bond vigilantes, as they're infamously known as, can hold, and do at many times hold, governments accountable for reckless spending. And I guess the question here, ever since that arose in the UK, is that something isolated to the UK, or can that happen to other countries? Right? We're seeing tremors in France. We're seeing the conversation continue to play out in the United States. But again, it's been playing out in the United States for a number of years, and nothing has yet to materialize. Although France, I think
that we can answer very easily. America's fine until they're no longer fine. There's essentially few other countries that people can shift that amount of debt to in the meantime. Germany and Australia are two of them. Sorry, Ruben, it might be New Zealand up there as well, but I don't know enough about their debt to be able to say yes or no. But if there was going to be a third country, it'd be New Zealand. But essentially, if you compare U.S. debt versus French debt, it's not in the same league. So not in the same interest rate, not in the same league from the vantage point of credibility. Now, that can change very quickly over the course of time if we get some more stability. So like we were talking about currencies, the flattening out of currencies, the move outside of currencies can come over the course of time with some stability. This could all change with the course of time with some stability, and other bond markets might become much more attractive, especially if they can get the stability and increase in interest rates. But that's not the case just yet. But we do know that the market turns very, very quickly. I was wrong. It wasn't 30 days. It was 49 days, by the way, Josh.
49 days.
So it's not my number one concern, but it should be a bigger conversation point. When we think of, the Bill Clinton debate, that was all about how much deficit spending each of the candidates were going to make. And now, a short 20 years later, it's just a back burner issue, because there's the expectation that America can spend whatever they want.
What's the expression? It's our currency, but your problem.
We finally adopted Cameron to be an American.
Perfect. We're just going to do a quick time check here, because I know we're getting a little close for time, and we want to make sure we answer any questions in the Q&A section. So we're just going to land the plane here nice and quickly of what this actually means, and well, hopefully the economy follows suit as well with the soft landing. And if anybody gets that pun, 10 points to you. But what does this actually mean? So we've discussed a lot of aspects when it comes to the political, the central banks, the policies going forward, and the markets and how they've behaved in the last couple of quarters. But what are we doing to our portfolios in particular? What are we doing for our clients, and what are some of the changes that you may see in your portfolio or have already seen in the portfolios? So we'll throw it up there, and these are some of the changes. Brian, why don't you walk us through some of these here while I open up the Q&A function here for our audience?
Absolutely. In a very simplistic way, we've been able to play very well in the last year. A nice barbell strategy of owning fixed income to complement our stock market portion. The stock market didn't have a big blip this year, but if it would have, essentially the fixed income component would have done even better than it did on the year. Now, that leaves our portfolio a little bit exposed to the effect that what happens if interest rates go up instead of down? What happens if we have a 1970s-like effect that spikes inflation all the way up the roof, it gets controlled, and then it jumps right back up? That's why we've started introducing some commodities inside of the portfolio. Because as you saw in Biden's beginning of his administration, when inflation went up in his term, commodities went up. They've come back down. But essentially, we want to have that barbell of a barbell. So that would actually hedge part of our fixed income. Cam put a little bit of a joke on the Magnificent Seven, and that's where we're looking at the S&P 493, i.e. other places other than just the Magnificent Seven, in case one of those were to fall apart. Say maybe one of their CEOs gets overly political and starts making faux pas all over the place, offending, well, half of the audience. That might be detrimental to one of those stocks. We're also starting to get back into real estate. This just gives us some further diversification from the stock and bond market, just like the commodities, but at a much larger discount because of the pullback from COVID, which we like. And over the course of the next year, you're going to see us decreasing our duration risk, which just means when we buy fixed income, the longer you buy it, the more upside it gets when interest rates go down. But at the same time, the more volatility it can have over the course of time. So as we get lower interest rates, or if we get lower interest rates, that will be the time that we pocket our profit and reduce our risk by owning shorter term fixed income. So those are the updates that you're going to be seeing in the portfolio. They're all quite small updates, and they're going to be build-ups over the course of time, because to me, the biggest risk we have in our portfolio is the Magnificent Seven not working and having too long a duration for too long of a period of time, to where we end up owning that when interest rates are moving up and not down, which increases our volatility. So we want to control that and just slowly reduce that over the course of time. Now,
Perfect.
Cam, I asked ChatGPT, my favorite friend, a question about a stock market to do with you. And I'm sorry, Cam, but it said, and this is just a joke for everybody's sake, why don't Cam, as the stock market analyst, ever read novels?
Pray tell.
Because the only numbers that interest them are in the appendix. So should we go to the appendix and the Q&A?
Let's
Cam's
do that.
sake.
It's a great segue there. So I'll give ChatGPT that one. Perfect. So we do have some questions that are coming along, but before we dive into the questions here, why don't we have a quick segue from Ruben about our DF Direct service?
Sure. Thanks for that, Cam. I'm Ruben, part of the team at Dunhill Financial, and primarily also look after our DF Direct service, which is our low-cost, no-minimum investment advisor platform that's built specifically for US expats. We have funds on the platform ranging from conservative to aggressive growth, making it suitable for anyone on their investment journey, whether you just want to reduce fees or if you don't want full financial planning services in the longer term, costing just 0.5% per annum. There's no additional trading fees, entry or exit fees, so it's nice and competitively priced. As you can see there on the pop-up of the screenshot, we have a webinar next Wednesday, October 30th at 2:30 p.m. British time or 3:30 p.m. European time, where we'll speak more about the platform, the aspects you can expect to receive on the platform, and we'll be joined by Anne, our financial planner, as we'll speak about building balance sheets. So we'll have a really interesting conversation there. But if you have any questions about the platform otherwise, feel free to reach out to me on ruben@dfdirect.com, and I'd be more than happy to help out.
Perfect. Thanks so much for that, Ruben. And then we've got an interesting question here from Richard. Given economists' universal condemnation of Trump's threats to impose tariffs on foreign imports across the board, but particularly from China, surely the markets and your minimization of the impact of the outcome of the US presidential election is misguided. Thoughts?
I love that statement. I am not a proponent of Trump or any of his policies, but I'm also realistic about how little he accomplished in his first presidential term, right? To me, the two main things that he was able to accomplish in his first term was, first of all, removing women's rights when it came to abortion, which essentially gave him everlasting ability to market himself amongst the Republican crowd as being able to get things done, and a huge tax cut, which got the other portion of the Republican Party behind him. The rest of the promises he made, for the most part, just disappeared. Think of that wall. That wall never happened. More of the wall's been expanded since Biden became president than when Trump was president. So the things that he states are the most important to him don't end up becoming the most important things when he's actually president, which we've got 14 days to find out whether he'll become president. So I don't think most anybody would let him actually put that into place, and I don't think it's the most important thing for himself to put into place. I think it's him trying to get a good negotiating position because he wants to try to go down as a great negotiator. That's why I'm not listening to all the words that he's stating, and letting it worry my position, just in case we end up with 4 more years of him being president. I almost said 4 more years of chaos, but it's the same thing, right?
Right. Tomato, tomato. So I guess really what the takeaway there, Brian, is it's reading in between the lines, right? Of not just some of the policies that Trump is championing, but also the other side as well with Kamala Harris, because we do have to understand that this this election is very close on both sides. So either candidate is going to make a lot of promises, and as always, what actually materializes is going to be something that only time can tell. And how Trump can continue advocating for some of those steep tariffs and not expect inflation to take hold, I don't know. Maybe he just doesn't have the right counsel. But as you mentioned, I think part of that is just the negotiating tactic of you start from a vantage of something ridiculous and then come down to something more reasonable, to where as you mentioned, it's using that leverage essentially.
We've seen the growth of Mexico and India in the last couple of years based on the weakness of China, based on these past rounds of battles between the United States and China. Neither side has any interest of de-escalating the conflict with China. Doesn't matter Democrats or Republicans. The Republicans are just taking it to that next level. Now, to me, it's more fearful when Trump is talking about universal tariffs beyond China, because that's just bringing about conflict globally. Bringing it about with China, that's a negotiating position. Bringing it about with Europe, that's just beating up on your friends. So we have to hope that he comes to his terms, or essentially that he just forgets about it after the election if he does get elected, and he doesn't go through with it.
Mm-hmm. And that is an interesting point that you brought up between the difference between China and some of the US's allies. And funny enough, I was actually at a conference on China and the impacts of the election and potentially a Trump presidency. And I think the majority of the consensus, or more so the hope, I suppose, is that despite these steep tariffs, Trump really wants to go down as somebody that achieves something, for lack of better words. And, we'll have to really see how some of those policies actually enact, right? Because when you slap on a 60% tariff on one of the largest exporters in the globe, sooner or later those prices end up being paid by the consumer, and that's just not even a debate, right? There's plenty of economists. I'm not sure if anybody saw the Hour Plus interview by Bloomberg at the Economic Forum between Trump and I can't remember the gentleman's name there. But the whole hour debate was trying to advocate that Trump's tariffs are not inflationary, and I don't think anybody there took that quite seriously. But we'll just have to see,
So-
whether those
so
policies come to fruition.
Can you go back one slide if you don't mind, Cam?
Absolutely.
So we will remind you, our biggest fear right now in the market is that interest rates go up, or I'm sorry, inflation goes up, which is why we're buying commodities, real estate, and decreasing our duration on our fixed income. All three of those would be risks of too high of tariffs. So these positions would continue to increase if he got elected, et cetera, because that would increase our hedge on those types of things. But there's a reason that those are coming in the market. So I'm in total agreement with you, Richard. I just don't think it's my number one concern out there. We have to just rank our different concerns. But our actions are behind the fact that we agree with that.
Perfect. Any other questions? We'll just give the audience a minute or so here. I know we're just on the timer here, getting towards the end.
If we don't have any other questions, what I'm going to do is I'll quickly introduce Anne. Anne is our new CFP on the team. We're glad for her to be joining us on the team. You'll start to see her on some of the different phone calls with Isa and Josh and Cam. So please be nice to her. We're hopefully going to get her over here to the UK soon. Hopefully not before it gets too cold, so that we don't scare her away. So just a big welcome to Anne to the team.
Thank you, Brian. I'm very happy to join the team. You're a great group, guys and gals.
Cam, great job organizing this as always. Anybody that has any questions, you know exactly where to find us. Ruben's doing a great job expanding the DF Direct. Great way to reduce your fees and be able to set up an account just about any place in the world. So great job on that. And reach out to us with any questions, big or small. If you want to curse the results of the election, you know exactly where to find Josh, our political specialists over there. And thank you, everybody, and have a great day.
Perfect. Thanks so much for your insights there, Brian, Josh, Ruben, Isa, and Anne as well. And thank you to the audience for attending. As I mentioned, a recording will be made available on our YouTube channel, so you can review it at your own leisure, as well as a copy of the full slides for some of the material that we weren't able to cover today. But other than that, I thank you all for your time, and have a wonderful rest of the day.